All right, so we're just gonna go over some tips, just some general tips in finances for your class, right? Um, Before you invest or do anything like that, you need to set aside any money that you need prior to investing. So you need to save money before you can invest money, okay? Remember that, that's very important. Save money before you invest it, okay? So set aside end of year expenses, insurance and taxes. This way you aren't shocked when at the end of the year you have to pay, because every year you got to pay your insurance and taxes. You're basically creating your own escrow account. So an escrow is like money that normally a mortgage company, when you buy a house, sets that money aside to pay your insurance and taxes for you. But in this case, remember, we're not buying houses, we're not getting loans and racking up debt. We're gonna end up buying our house, and then that way we got to do our own escrow. That way, because if you spend your money at the end of the year when your taxes and insurance will due, you're like, oh shit, I gotta hurry up and scramble and get some money together to pay my insurance and taxes, right? So set aside your money to get for your insurance and taxes. My rule of thumb, what I would always say do, is set aside 10% for savings. If you set aside money every week, like if you get paid weekly, monthly, bi-weekly, monthly, whatever, take 10% of your money and set it aside, for yourself, and that's before taxes, right? So like, let's say you make $1,000 a week, right? I'm just going to use real simple numbers, right? So let's say you get taxed, and Uncle Sam takes $150 out of there. Well, you're not going to take 10% of after taxes. You're going to take 10% before taxes. Okay? Make sense? So let's say you take that 10% out. A lot of people will say, well, I can't live off that and stuff like that. Well, if you do it in the beginning, when you first start working, you don't really miss the money. You don't miss money you didn't really ever spend, you didn't ever have. So before, you may have been taking that 10% and blowing it on frivolous, stupid stuff. But if you're setting it aside for savings, you don't really miss that money because you never really had it in the first place. Make sense? Mm-hmm. Okay. Kind of lost my place here. But yeah, so set aside that 10% of before taxes. Then I would invest in stocks, right? So my first thing I would do is invest in stocks, not real estate, not a business, nothing like that. Let's invest our money, make that money grow for us. So, I would suggest buying ETFs, which we talked about creating our own ETF and how to do it right, looking at the markets and which is the best index and the best sector and all that stuff. So we create our own ETFs of finding the top 10 to 30 companies in that sector. And, so that's creating your own ETF. But also, like I said about electronically traded funds, okay. ETFs. But also remember what we talked about is creating your own ETF versus using a stockbroker. You can use a stockbroker, but a stockbroker is going to take a 5% commission when you could pick your own top 10, 30 companies and pay 0 commission or fees on one of these stock trading platforms. So you just saved yourself 5%, because then using a stockbroker, you got to make 5% just to break even. Not to mention having to gain another 3% just to break even with inflation, and another 1% because Uncle Sam's going to take, his taxes and stuff from your capital gains.
That's 9%.
So that's 9% that you have to make just to break even. And most time these stock brokers, they don't make 9% historically, year after year. So why am I going to give you 5% of my hard-earned money to not even make me 9% to break even with, it makes no sense. Mom scratched out when I said a bad word on here.
Yeah, she did.
Now, if you want to, once you've created an ETF, right? Let's say you go out there and there's a certain company that's not in that, index and that sector and that industry, and one of your 10 to 30 companies that you picked for your own ETF. Let's say there's a company outside of that that's doing really good and you want to go and invest in them. Then do as much research as you can on that company, because if you're going to really bet on one company that is historically not in the best sector and industry and top performing companies and stuff like that, you really want to do your research on that one company and make sure they're a good pick. So how do you kind of drill down and figure out what companies there are? And you could do this with some other with your companies in your ETF, but I would strongly suggest doing this if you're going to go outside of that, because the reason I wouldn't really worry about it too much on your own ETF is because the companies like we were looking at, those top 30 companies, we've already established the strongest sector and industry and the top companies in that industry. So we know historically a projected pattern of where it's going. But if you're going to go outside of that historic, base, then you're really going to want to do your research and make sure that what you think this company is a good company, even if they're not historically, because historical averages aren't always a catch-all, because even companies who've shot up and done great have also shot down and done shitty. So how do you do that is you can watch the indexes. If the indexes are going up, then primarily most companies are going up. And when the indexes are going down, primarily most of the companies are going down. Major economic reports. So quite often, the country and other companies working with the countries, not just US, but all the different countries in the world. So everything that the US does, all these other countries and all these other markets and indexes and stuff, they're all doing the same thing too. So they put out reports like, housing reports, unemployment reports, oil production reports. There's so many different kinds of reports. And you can go on Google and you can just type in economic reports. And there is a ton of websites out there that, you can go and look up their reports. And they do the same thing. So let's take unemployment. Unemployment is one of the biggest reports because, well, if a lot of people are working or more people are working than before, then the economy's going up. And if the economy's going up, the indexes are going up. And, so you can't have a good, strong economy if you don't have everyone working, right? Kind of makes sense? So, and they kind of do the same thing too. They look at historical data. They say, well, if, this company or this report, we've been historically seeing, this pattern of growth or this pattern of decline. And then they have these analysts who say, well, we predict when this report comes out, it's going to say this. So let's say unemployment, for example, they say, well, we believe this quarter or this month, America has added 250,000 jobs. But then the report actually comes out and they created 300,000 jobs. Do you think because we've created more jobs that the economy, the indexes are going to go up or down? Right, yeah, so more people are working, that's good news. That means more people have more money in their hand, which means more people are going to spend more money, which is going to circulate money through the whole economy and just kind of charge the machine up, get it going, right? But if they say it's going to be 250,000 people and only 200,000 people, and the report comes out and only 200,000 people, got jobs, what do you think is going to happen?
Those are the same numbers.
Or if they say it's going to be 250,000 people get hired and only 200,000 people get hired, which way do you think the market's going to go?
Down.
Right. So these are reports you can do. There's all kinds of reports. Now here's the thing. Don't put all your eggs in one basket and rely solely just based on what analysts think. Analysts are kind of like weathermen and pollsters. Weathermen get the weather wrong all the time. They're just smart people making educated guesses, and they're wrong a lot. Pollsters are people that say, well, I think this politician's going to win this race, and they're wrong a lot. So, they might be wrong 6 times out of 10, but they're wrong. They might be right 6 times out of 10, but then they might be wrong 4 times out of 10. So, take what they say with a grain of salt. Don't just rely wholeheartedly on like, oh, well, so-and-so says so, well, it must be so, right? So economic reports. Then you also have company reports, right? So let's say Exxon. You know what Exxon is, right? Oil and gas?
Yes.
Okay, so Exxon, like the gas stations and everything. So Exxon may put out a quarterly report called a K1. Anytime a company pulls out a quarterly report, they, go through this big long list of how they did and how they think they're going to do in the future. So they may say things like, well, we did really good this quarter, and we think we're going to do really good next quarter. Now, granted, I'm saying very basic stuff, and they go into great detail. And one time we may actually go and just listen to a quarterly report just so you can see what they say and how it goes and everything, and see how boring it is, because it is fucking boring as hell.
I probably thought so.
Yeah, I do too. But it's good to go to one and listen to one just so you get a grasp, right? Just get a grasp on the concept. But it's a bunch of boring old men standing around going, well, the earnings per share was up 28% over the last quarter, right? So kind of dorky, boring stuff. But like I said, it's good just to do it once. Unless you're really into that stuff, like Warren Buffett, one of the greatest stock investors, or the greatest stock investor of all times, that's all he does is just read economic or, all kinds of reports and stuff. But anyways, so, you can look up quarterly reports. Now, kind of like the economic reports, let's say you have these analysts who say, well, we think that such and such company's earnings per share, and I'll go into all these specifics, these earnings per share and, expected, next quarter expected revenue. I'll go over all that stuff later. But let's say they say, well, our earnings per share this quarter went up 28%, and next quarter we think it'll go up 30%. Do you think their stock is going to go up or down?
I'm confused.
Okay, so let's say an analyst. Let's say I'm an analyst, right? And let's say I predict that when Exxon comes out with their quarterly report, they're going to go up 25%. And then when Exxon actually comes out with their report, they say they went up 28%. So, and then they say the next quarter they're going to go up 30%. Which way do you think their stock's going to go? Up or down?
Up?
Right. So they beat, it's called beating expectations. If a company, if an analyst says they're going to go up or down a certain percentage, and let's say they just meet the expectations. Let's say the analyst said it goes up 25%, and then the company says they went up 25%, they met expectations, right? So that's still going to make the stock go up. But let's say they say, well, it's going to go up 25%, but then they say, well, we actually went up 28%. It's going to make it go up that much more. Now, now it goes the other way too. I want to set this down for a second. Let's say it goes the other way. Let's say they say, well, the earnings per share we think is going to go down 25%. Well, if the earnings per share went down 25%, which way do you think the stock is going to go?
Down.
Down. All right, now watch this. If they say the earnings per share is going to go down 25%, but they only went down 20%, which way do you think it's going to go?
I thought it was a trick question because I don't know how to answer it.
It is. Okay, so they said it's going to go down, but it didn't go down as much, right? So their stock price is still going to go down like they expected it to, but not as much. But what if it also does the same other way? If they say it's going to go down 25%, but they say they actually went down 30%, it's going to go down further than they thought it was. So it's all about expectations. Keep that in mind. If you do as good, it's going to go up. If you do better, it's going to go up higher. Or if you do not quite as good as expectations, it's still going to go up, but not as much. And the same way on negative expectations. So you have positive and negative expectations. Okay? Make sense? I know I kind of went into a long spill about that, but it is important, right? So you have company, reports. We've already talked about company trends. Sit up.
Still has sleep sitting up too.
Now, here's a good way to know daily trends. Now, I know we said we don't really watch daily trends, right? Remember when we pick companies, we're looking at historical, 1, 5, 10, and max. But that doesn't mean we don't pay attention to like daily and weekly and monthly and quarterly trends, because those things do add up and eventually become annual 5, 10, max trends, right? So we want to stay with our ear close to the ground so we can see a pattern developing. Like if you go to a stock future, so here's what a stock future is. It's the same thing as buying a stock, but you're buying it before market hours. So the market is open from 8:30 a.m. This is Eastern time, 8:30 a.m. to 3:30
We're
p.m.
on Central Time.
I know the market's still.
I know. I'm just asking.
So then it'd be 9:30 to 4:30 Central, right? Because we're an hour difference, right? But so they're open 8:30 to 3:30 Eastern, right? So before, when the market's not open, you have pre-market and after-market hours, right? So on the pre-market, you buy futures, and that's basically a prediction of the stock market, what it's going to do that day. So if the
Is that why when I look at the stock market after a certain amount of time, there's like a little section that's gray?
Yep, that's it.
Okay, because that was very confusing for me.
Yep, that's the pre and the after markets. So if like let's say you go and look at the stock futures and there's the stock futures are up 0.5% today, it's a pretty good indicator that the stocks are going to go up 0.5% that day. And if you see it going up more and more, more up than down that week, that's a good indicator that, there's a trend. It's starting to go up. And same for the month and the quarter. And then that becomes the year. Now, that doesn't mean anything, really, because just like the report, the global reports, the national reports, the economic reports, the company reports, the analyst, no one can predict the future. So when you're watching, these things, just because it goes up 0.5% that day, something may happen that could devastate that trend. So let's say let's say Russia dropped a nuclear bomb on New York. You think that might affect the stock market?
Yes.
You think it might affect it negative or positively?
Well, it depends on the market, because it will.
If Russia dropped a nuke on New York, it's dropping the whole damn market.
Well, that depends on what companies you're looking at. If you're looking at companies that sell weapons, it's going to go up because they're going to bomb Russia back.
See, now you're thinking. I was just giving a overall, but you're already dialing in to a further, you're already.
Can we go
you're already.
back? Can you go back over the pre and post market, what it was called? Because I'm trying to write it down and I forgot.
Okay, so futures.
Okay. How
Futures.
Do you spell that?
Future.
I can't spell that.
Future. Future.
I always end up spelling it wrong.
Actually, it's not even chur like we say it wrong. It shouldn't be future. Future.
Yeah, that's why I always spell it
Anyways.
wrong.
But, right, so like Lockheed Martin, Northrop, Boeing, all these, military industrial complex companies, their stock market's gonna go boom.
Yeah.
But, yeah. And usually companies like oil and gas.
Because
and
you need oil and gas to fuel the planes.
And a lot of times wars are started because we're attacking some country that has oil and gas. I want your goddamn oil. Just saying. It's a bully move. War is always a bully move. It's just I'm bigger and stronger. Give me your shit. A lot of times we just justify war as being like, well, we have to fight communism. That's almost always a lie. It's almost always has to do with money.
Yeah.
Always. Or power. Money or power,
Yeah.
which are kind of synonymous. They kind of go together. But anyways, so that doesn't mean just because a future is up. Like, a future may be up because people are like, oh, well, we think the Federal Reserve rate, that's another really big economic report. The future, the Federal Reserve, we think is going to lower the Federal Reserve rate by 0.5%. And then they actually keep it the same, or even worse, make it go up, 25%, something like that. Then if that's the case, then that's going to send a direct opposite, maybe going up, and they say, oh, we think it's going to go up 50%, or 0.5%. We went up 50% in a day, holy shit. But may go up 0.5% in a day because of what we think the Federal Reserve rate is going to be. But then if the Federal Reserve rate does something completely opposite, it may go. But same time, say they think, well, we think the Federal Reserve is going to cut their rate by, 0.5 point, and they actually cut it by 1 whole point. Instead of going up 0.5%, it may go up even more. So it's all about expectations. So if you think something's going to happen, and then, the reverse happens, good or bad, it could shoot it a different way, right? So just keep that in mind. The stock market is always changing based off news and expectations and stuff like that. But in the end, historical averages always win, because what you think happens and what does happen are two different stories. But the longer you can look back into the past, the more readily, the more closely you can predict the future, right? That's why, investing in IPOs, initial public offerings. That's basically companies that are brand new. Investing in an IPO is pretty, it's tough. It's very hard because you have no historical data on them. It's a crapshoot. You know, if you get on the ground floor on an IPO in the beginning and they do great, man, that could be awesome. I mean, think if you were one of the ground floor people on NVIDIA, you'd be a freaking billionaire. But, you know, you never know. Who knows? To me, I'd rather play it kind of safe than sorry, but I don't want to play it so safe there's no real gains in it either. So it's kind of somewhere in the middle. Now, once you have invested your money, right? So this is like what I was saying is invest your money in stocks first. Some people I know a lot of people out there are going to say invest in your house, invest in a business, stuff like that. The reason I say invest in stocks is because you can buy smaller chunks that are more liquid and have a good rate of return on stocks than say like CDs and bonds and all that other crap. But stocks, you can have a greater rate of return on a smaller investment. Can you buy a house for $1,000?
No.
Okay. Can you really start a business with $1,000? No. Can you buy maybe a couple shares of a company for $1,000 with $1,000? Yeah, right. So it's a easier point of entry. It's an easier point of entry into the stock market. Then go start your own business. So like, let's say you did the research and it takes you, I don't know, I'm just throwing numbers out there, $100,000 to start a business, right? Well, you go out there, you invested all your money onto these companies, right? The best investment you'll ever make is yourself. But it's a bigger entry point to start your own business. That's why you invest in stocks and other people first. Build your money up. Once you got that money saved, then go start your own business. Pour all your heart, your mind, your soul, your money, your time, your passion, everything you got. Pour it in to your business. Stockpile your money. Then buy you a house. So like, let's say it costs $500,000 to buy your dream home. Well, you had a little bit of money and invested in stocks. You turned it into $100,000. You took that $100,000. You started your own business. You took that business. Now it's worth $10 million. Now you take that money and you buy yourself a house. And then you start, you're still doing all these things like setting aside that 10%, right? You're still setting aside that 10%. You're still investing it into the stock market. You're already done with the stock market. Now you're investing it in your business. Now you're just taking that 10% and you're reinvesting it in yourself. You're not investing it into the company in there. Now you need to invest in yourself. Maybe you need to hire more people. Maybe you need to buy better software. Maybe you need to buy better tools. Whatever you're buying to invest in yourself. So then you're building your company. Once you get to a certain point where you go, okay, now I can buy a home, right? So if I have enough money, I can go buy a home in cash. So no mortgage. Go buy your home in cash. And I know, like I'm saying this like it's easy peasy and stuff. It is not. I don't want to sit here and lie to you and make you think, I can. Just hold off for a second. We're almost done. I'm not saying this is easy. By no means is it easy. Nothing good, worthwhile is easy. Nothing good in life is easy. It will be hard. You will run into trials. You will have things happen to you that make you scratch your head and go, what the fuck? Why did I ever do this? This is insane. This is hard. This is heartbreaking. It's gut-wrenching. you know, I don't know, you know, everything. You will doubt yourself. You will doubt others. You will, but you know what you will do? You will keep working. You will keep trying. You will not give up. And before you know it, you are that person who took, you know, 10% of your little measly paycheck, invested it wisely in the stock market, built up a nest, you know, built up a good little nest egg, started your own business, grew that business, buy a house. You know how I know? Because I did it. And if I did it, anyone can do it. I'm stupid. I am not a smart man. I am just well educated on the things that I'm passionate about, the things that I like. And I went and educated, learned some from reading, some from watching books, having mentors.
How do you watch a book?
Or watching movies, you know. Anyways, watching movies, reading books, having mentors, making mistakes, learning from my mistakes, moving on, working hard, never giving up, regardless of whatever problems I had. And then look, I did the same thing. And I'm a high school dropout. I'm an ex-con. I'm a felon. I'm a guy who used to, you know, drink and do drugs. You know, I got into fights all the time. I did everything wrong. But then I also turned it around and did most things right. But I'm just saying, if I can do it, anyone can do it. That's all I'm saying. Not the smartest man in the world, but, you know, I'm not the dumbest either. So that's why I'm saying also find your life purpose, right? We always talk about your life purpose, because once you decide to start your business, that money that you invested in, you invest it into the business that is aligned with your life purpose, your passion, what you're good at, what you love to do, what you can make good money at, something the world needs, right? We always talk about making those 4 columns, and when you find the one thing that's in all 4 columns, that's your life purpose. And so that's the whole, this is what it's all leading to, baby girl. Like, this is what we're all talking about, you know, or this is what I'm talking about, you know, doing the little things, taking that little 10% of your money, setting it aside, investing it, you know, having it grow, start your own business, buying your own house. All these things are little stepping stones to a big mountain of success, right? Is what it's all about. That's what it's all about. So, anyways, all right. So, feel like you learned something today?
Yes.
What'd you learn? All right, repeat everything I just said.
I didn't know about everything. I just went to what
I know. We'll talk about it later. And trust me, as we go on in your life, some of the things I've said, you've heard me say before, right?
Yes.
You're going to hear it a million more times, because I'm going to drill it into your
You
brain.
like to repeat yourself a lot.
Right, because I'm drilling it into your brain. I'm brainwashing you for success. Repeat after me. I will listen to my dad, because I will become successful.
I don't ever repeat that, but it's probably true.
Yeah. Anyways, all right. So, guys, that's our financial tips for, I know it's kind of a long video, but it's a good one. It's worth it. Listen to it. Remember it. Write it down. Take a picture. I don't give a fuck. Anyways, all right, guys, subscribe, share, comment, like.